Hi, everybody. Welcome to Trader Minute. It's great to have you aboard. I'm Carl, and thanks for tuning in today for a class on charting for Education Week. And charting, there's a lot of different aspects to charting. Technical analysis is a name for this, and technical analysis is the examination of past price movements to forecast future price movements. Okay, now it's a lot like weather forecasting, right? You think about it every night, you watch your meteorologist, and what's he doing? He's standing up there and he's predicting the weather. He's predicting what's going to happen today, tomorrow, a week from now. I've seen him look out as far as a month. All right. Now, are they always right? No, they're not always right, but they got a lot of tools nowadays that make them fairly accurate. They've got Doppler radar, and they've got historical patterns that they can look at. They can send those balloons up into the jet stream and see what the jet streams are doing, and the high pressure and the low pressure. And I'm not a meteorologist, but you know what I'm talking about. So they know, based on historical patterns and these different types of indications that they can get from their tools, whether or not, what the weather's going to be like. And they know that if high winds and high winds, if a warm front meets a cold front, they're going to have high winds and rain, right? And that's the weather for tomorrow. Okay, it's not always accurate. It's the same thing here when we're looking at a chart. We've got tools. We can look at historical patterns. We can look at trends. We can look at support and resistance levels. A lot of different things like that to help us predict which way the stock price is going to move. Does it mean it's going to move that way? No, but what that does is put the odds in our favor. When we see a nice entrance signal, when you see my top three, when you see us making trades, what we've determined is that the odds are more so in our favor than against us at this point, that the stock is going to make a predicted move. Okay. Again, it's not a science, but there can a lot that can go into this. So what I first want to do, I want to pull up a chart here, and let's just talk about candlesticks. One of the basic things. And when I got into trading over 15 years ago now, I saw these candlestick charts for this first time. And, here they were. I looked at that and I thought, what on earth is that? And then in my mind, I'm thinking, why can't they have these nice little line charts? They're so much easier to look at. Now I look at a line chart and that tells me nothing. Okay, but back in the day, it's like, hey, why not just a simple line chart? That'd be so nice. Because the candlesticks didn't make sense to me. But if you know how to read candlesticks, they add so much more to your investing. They can make predictability, take it to a higher level when it comes to technical analysis. Okay, there's candlestick patterns, which can be, some are more accurate than others, and then there's, here at stock charts, there's a couple other different formations that I will show you as well that you don't find at other places. All right, now candlesticks were created a couple hundred years ago in Asia by, story goes, a famous rice trader, and this guy wanted to know when to buy rice when it was cheap and when to sell it for a higher price. And so he just developed a method that has turned into what we call candlesticks. And back then, I'm sure he was drawing that on rice paper. And a lot's changed since then. We have candlesticks. Now, candlesticks, they represent 5 important pieces of information. And you can get into a lot more than that, but let's just start off with 5. So if you look closely here at these candlesticks, you're going to notice that there's 2 types. You have a hollow candlestick and a filled candlestick. A hollow and a filled. Now there's different colors of filleds and different colors of hollow candlesticks, which I'll get to here shortly. But let's just stick with hollow and filled. That's the 2 types of candlesticks. Okay. Now a hollow candlestick represents a day that the stock price went up. Now, if you're looking here and wondering what that yellow candlestick is on the far right, well, that's today's candle. That means it's still being drawn. It hasn't closed yet. Okay, once the market is closed today, that yellow will disappear and the prices will be marked in there on the candlestick. So on a hollow candlestick, it represents a day. Each one of these candlesticks is one day. You can put in minute candlesticks, you can put in weekly or monthly candlesticks. Okay, but at stock charts, the basic setting is a one-day candlestick. A hollow candlestick means it went up in value, so it opened at the bottom of the body. So on this one right here, it opens at the bottom of the body and closes at the top. It went up in value that day. So from that day, it opened just over $48 per share and closed up here around $50 per share on this day right here. Okay, so that's a hollow candlestick. You can also find filled candlesticks, and I'll go with this big one right here. And a filled candlestick represents a day the stock price went down in value. So it opened at the top of the body and closed at the bottom. It's just the opposite. It means it went down on that day on a filled candlestick. All right, now you might notice that there's some wicks. Some people call them shadows that come out of these candlesticks. Not all of them, but on a lot of them. Now the wicks represent the trading range of the day. So a wick coming out of the top of the body represents the highest price that the stock has reached that day, and one coming out of the bottom of the body is the lowest price the stock has gone that day. Okay, but it has opened and closed within the body of the candlestick. Okay, the wicks just show you the range, the high and the low of the day. Okay, now, here at Stock Charts, you're going, and we're not affiliated with Stock Charts, just to let you know. Love the service. We're not affiliated with them. You will find what they call a black filled candle, and you pretty much just find these here at Stock Charts. There's a better looking one over here that I will show you right up here. Right up here, a black filled candlestick. Now a black filled candlestick, it's a filled candlestick, which means it opened at the top of the body and closed at the bottom, just like a normal filled candlestick that's red. However, what happened on that day is the stock gapped up, which means it opened at a higher price than the day before, and you can see how that did that. Here's where the day before it closed at that price, and the next morning it's up here. It gapped higher, went down in value for the day, but still closed at a higher price than the day before. That's a black filled candlestick. Now black filled candlesticks represent weakness. Okay, they're not very accurate, so you won't see us making a trade because there's a black filled candlestick. And yeah, you can look around and say, oh yeah, that one worked. Well, that one didn't. Yeah, that one did, and that one didn't. We're not going to use it. Those are not valid entries. Okay, to us it just gives us a little bit more information. That's about it. We're not going to make a trade based on that. Now I don't see one here, but you will also, there's one right over here. It's not a very good example, but you will also find red hollows right there. Now a red hollow, well, it's a hollow candlestick, which means it opened at the bottom of the body, closed at the top, so it went up in value. But with a red hollow candlestick, what happened is the stock gapped down. So it opened at a lower price than where it closed the night before. Went up during the day, but still closed at a lower price than the day before, which is a red hollow. Now, they say that's not a very good example because it looked at it closed like right at the same price the day before, and it might have been a cent lower, and it still formed a red hollow. Now, a red hollow candlestick represents strength. And yeah, and you can see that it did go up after that, but again, they're not very accurate candles. They're not even really called a candlestick pattern. You'll just find these here at Stock Charts. Okay, so they're not very accurate. They can work from time to time, but to us it's just going to give us a little bit more information. Right now, there's some other candlestick patterns that you'll see us trade on or get out of a trade if we happen to see them. They're scary to us. If we're in a bullish trade, And there was one of these the other day on Krispy Kreme. And AK, if you're out there, you remember that one. But these candlestick pattern, that right there looks like an upside down T. It's called a gravestone doji. Gravestone doji. And gravestone dojis are quite accurate. And this is a great example of a gravestone. Now, not all stocks are going to react the same way around candle patterns. ETFs, candle patterns for the most part don't mean much. Okay, but with individual companies, it's going to vary on how accurate they are as well. Gravestone dojis and Tesoro are fairly accurate. So what happens with a gravestone doji is you'll find the stock in a little bit of an uptrend. And then it forms what looks like this upside down T right there. Right, the upside down T. So it looks, that's called a gravestone. I like the name too. It's cool. Now a gravestone doji means short-term reversal. It's not one of the big long-term, okay, stock's in an uptrend, now it's going into a downtrend type of a deal, usually. It means short-term reversal. It means if you're in a trade, you're in a bullish trade on that, I would exit. We saw one on Krispy Kreme donuts the other day. It went up, gapped higher, formed a gravestone doji, went down the next day. If you see us in a trade, and again, it's going to vary on the stock. Some stocks are going to react to these patterns more than others, and ETFs, it almost doesn't matter with the candlestick pattern. But a lot of stocks, if we're in a bullish trade and we see a gravestone doji appear, most of the time you're going to see us pop out of the trade if we're in bullish. If we're in bearish, then that's a great sign for us. You can see there's another gravestone doji right there. And did it work? Sure thing. Okay, now those gravestone dojis have to set up pretty nice, because you can look down here and see, well, hey, look, there's a gravestone down there as well. But it's not really set up right. Okay, it did go down, but what you want in a gravestone is this, where you want that uptrend. You want it near the top of an uptrend is where they're going to be most accurate. The opposite side of the coin here is what's called a dragonfly. And let me look here. I don't see any real dragonflies here. There's one that has the principles of a dragonfly, called a hammer pattern right here. A dragonfly basically looks like a capital T. It'll look like that. And for a dragonfly, you want it to be at the bottom of a downtrend. Near the bottom of it doesn't have to be a big downtrend like this. It could be a shorter term downtrend, and you might be able to find one in a trend like this, where it's shorter term, you see a dragonfly and have it work for it. But this one, it's not a true dragonfly, because you can see it's got quite a wide body there on that candlestick around the 20th of August. Okay, but it had the principles of it, and you can see it jumped on that. But again, these candlestick patterns, there's one that's pretty similar over here on a little bit of a downtrend as well, down tick as well, and it did pop a little bit higher. Remember, they're not trend changers. This is not saying that this downtrend is over. It's saying this is going to likely experience, and I say likely experience, some short-term strength. They're not 100% accurate, but these are up there in the accuracy ratings if you use them right and if you find them in the right areas. Okay, so those are just a couple of the candlestick patterns out there. You'll hear us talk about a lot of patterns. What we like to do here is try to put many of the odds on our site as possible, and we'll look at chart patterns, we'll look at candlestick patterns, we'll look at entries as far as indicators and trends and so forth. There's a couple different templates that we use here called a Vibe and Trend Writer. I'm not going to get into those details right now, but let's continue on with some basic charting. Now, one of the things that you're going to hear in the stock market, if you're new to the market, and if you've been in it, you've probably heard this before, how the trend is your friend, right? You always try to trade in the direction of the trend. However, with that being said, if you are a contrarian trader and you know how to trade against the trend, you can be highly profitable in knowing and looking for the right opportunities to catch some short-term weakness, or even catch some corrections in the market as they come. All right. We're not going to get into contrarian trading right here, right now. We're just going to some basic charting services. So you're going to hear about the trend. You're going to hear about support and resistance. Now, let's talk about support and resistance. We got to remember, whenever we're looking at a chart, you're looking at human behavior. It's a bunch of humans out there, and if it's program trading, hey, who programmed them? Humans, right? So let's some of the strongest levels of support and resistance are going to be on big round numbers, such as multiples of 10. And you'll hear me talk about this quite a bit. Now think about it. When you go buy a shirt, and I went and bought some shirts the other night. You go in to buy a shirt. What do they cost you? $39.99, $49.99. And I always tell my wife, it's $50. And she goes, no, it's $49.95. No, it's $50, right? You know what I'm talking about out there, right? And it's the same here, and they price it because it just sounds cheaper, right? It just 49 anything, even if it's 5 cents or a penny away from 50, just sounds so much cheaper than 50 something, right? It does. It's the same thing here in the stock market. So you look at a big round number like a multiple of 10, such as 50 right here, and guess what? Well, here comes the stock. It's barreling down, coming off of 60, coming down here, and all of a sudden, magically, it holds a big round number like 50. Is there some kind of a wall or barrier right there? No. What happens is, as the stock approaches 50, it becomes a self-fulfilling prophecy. There's a saying out there in the market that says buy on support and sell at resistance. Buy on support and sell at resistance. So what happens as this stock comes down here, approaches 50, the buyers start stepping in. And in their mind, they're thinking, no, this stock's, it's not going through 50. It's going to hold 50. Okay, and then you got the people that own the stock thinking the same thing. Well, I don't want to sell it here. It's coming down on 50. That's likely to be support. So what happens? Well, the buyers step in right there, and the sellers, they don't want to sell. So there's not a lot of selling going on. There's a lot of buying that picks up around 50, becomes a self-fulfilling prophecy, and there it goes. It holds 50 magically. Okay, now eventually these support levels can be broken, like happened right over here on a major sell-off here. It went right through it. Now, most of the time, not all the time, but most of the time when stocks break these big levels like this, they will come back and retest that level to see if it holds, in this case, on the break here to the downside, to see if it holds as support. As new resistance. And you notice it went down below it, came back up to it, tried to reach it a couple days, didn't even get close to it, and then pushed back lower. That's a great looking entrance right here. If you can see this come back up to resistance, even if it hits resistance and then pushes back down off of it hard, like on a big candle right there, odds are that stock's going lower. It just locked in a new level of resistance at a lower price, and it's a big number like a 50. Okay, same thing over here. So when it came down to support, what did it do? It held it, came back and retested that level right there. Did it hold? Yeah. It shot up right off of it, and then it even came back twice. You can see that hold, and you notice the levels that it held were above 50. The second time it held it was even higher, above 50. Strong chances on these holds like that it's the second one will be a better move than the first. You don't always get that double retest like that, but in this case you did. Okay, so that's just some very basic support and resistance. Again, the stronger levels are going to be the multiples of 10, 50, 60, 100, and things like that. Okay. Now let's look at some indicators. We got an indicator here on top, and you're going to see us use a variety of indicators. For the most part, we use indicators that help us as well put more odds on our side. We have what's called the RSI right up here on top. Scroll out, you can see that. Okay, the RSI stands for the Relative Strength Index. Numbers from 1 to 100. It's got some bolded lines there. The bolded lines are 30 and 70, with the center line being 50. Okay, now a stock, when it gets below 30, it's considered oversold. Becomes in an oversold condition. When it reaches these levels, it can go up, but it doesn't mean once it gets down below 30, the stock's going to reverse, because it can stay down and even keep running down lower. Really, the bigger number is to get bullish on a stock is when it breaks 50. The RSI breaks 50, comes down to it, pushes up off of 50. That's when you can have let me back out of that. Sorry, I was just trying to do this. You can see where the RSI broke up through 50, right about this point right here, what happened to the trend. And recently, where it came back to 50 and pushed up off of it, what's going on down here. So this can just give us, put a little bit more of the odds in our favor. Hey, the RSI, now it's above 50. When the RSI is above 50, stocks are typically uptrending, showing some strength. When it's below 50, they're typically downtrending and weak. Okay, that's one of the things you're going to watch us look for when we make TrendRider entrances, is a push of the RSI breaking up through 50 or uptrending up above 50 is what we're looking for on a TrendRider bull entrance. Down below, a break of 50 for a bearish TrendRider would be a break of 50 or trending lower on the RSI. So the RSI, we like that indicator. We also have what's called the Bollinger Band width, and this is we use the Bollinger Bands here. You're going to hear a lot of talk about Bollinger Bands. We like to use these because they help us spot levels of volatility. Okay. As far as the Bollinger Bands, when they get tight, you can see right through this range. When they got tight, what you're looking for to see which way they break out. They break into the lower Bollinger Band, the stock's likely to continue lower. Break into the upper band, it's likely to continue higher. They spot these levels like that. They can also be used as support and resistance as well. I don't want to spend too much time in the Bollinger Band. Another indicator that you're going to see us use here, it's on what's called a vibe, is the MACD. Okay, MACD stands for Moving Average Convergence Divergence. Say that 5 times fast. It's a mouthful. But the MACD is designed to be more tempered in its moves. You don't get all the ups and down jig jags that you're going to get a lot of the other indicators. That's another thing we'll watch for. It's very simple to read. When the MACD line, which is the black line, when the black line crosses up through the red, that's a bullish signal. When it crosses down through the red, it's a bullish signal. We don't trade based off just these signals. The MACD tends to be a lagging indicator. It's pretty slow. It gets you in trade sometimes way too late, and it gets you out way too late. You could get in a little bit early. What we like to see is look at the trends of the MACD and the RSI. You notice right now the overall trend of the MACD is positive. For the MACD, one of the things we like to see is for the lines to break above 0. When the lines break above 0, very bullish. When they break below 0, it's very bearish. So one of the things we'll watch is see where that's at. Right now it's uptrending. We did get a positive signal here in the MACD. Again, we don't enter trades based on a bullish MACD signal. We're going to look at a lot of other factors as well. That's another indicator you're going to see us use quite a bit here. One more indicator that you will see us use, and I'll just put that in there. It's called the slow stochastics. I'll just take this out and put in what's called the slow stochastics. And this is another indicator that we can use to help determine overbought or oversold conditions. The readings here on the stochastics above 80, stocks a little bit oversold. Just because it's up here doesn't mean the stock's going to roll over and go back the other direction. It can stay up here. I've seen it stay up here sometimes 4 or 5 months on the stochastics. It's just saying short term it's a little bit overbought. Okay, Below 20, oversold. Same thing, just because it gets down here doesn't mean it's going to reverse. What we're looking for here is a breakup through 50, typically, for some bullish sentiment. And down here, same thing, it pushed back up off of 50, positive, bearish, breaks below 50. Okay. So those are some of the basic concepts that you're going to hear us talk about. Now I'm going to bring up what's called our vibe, and I bring this up because we got a lot of moving averages here, and we've got 3 averages here, and they're all color coordinated for you. The green here is a 200-day moving average, the red a 100-day moving average, and the blue is a 50. One of the things that you're going to hear us talk about a lot in the live trade seat, in the notes, is what we call the it's just a simple 7-day moving average. And I say simple because there's also exponential moving averages. We use a simple 7-day moving average. And prices tend to stay around the 7. Is it a magic number, 7 versus 8 or 5? Not really. It's just one that we're comfortable with. And what we've found that stocks tend to gravitate to. Now the 7, whenever stocks get a long ways away from the 7, like right over here, at this point you can see how far the 7-day moving average is on that day. You look right here, 7-day moving average is way down here. There's the stock way up there. When the stock gets a long ways away from the 7, it means it's due for some consolidation. Okay, consolidation meaning it's going to come back to it. It's likely to come back to it. It always does. Bullish consolidation would be kind of a slow move sideways, maybe slightly lower, and let the 7-day catch up to it. Bearish consolidation would be like we saw here. Some really strong moves down. Okay? And we'll use the 7-day moving average as our stop a lot of times, meaning if we got into a trade right here, when it closes below the 7 is where we get out. Okay? If we get into a bearish trade, if it closes back above the 7, that's where we get out. So same thing, when stocks get a long ways away from it on the upside, they're likely to come back to it. When they get a long ways away from it on the downside, same thing, they're likely to come back to it. They will always gravitate to it. And so when you're in trades, or right now we look at Tesoro here, it's $2 above the 7 right now. The 7's right around 50. It's up here over 52, 52.60. And so this is saying the stock might consolidate. It doesn't mean it's just going to come back down. It can just keep going. It can keep that $2 gap and just keep running with it. We've had stocks do that to us. They think, oh, they're going to come back, and it just keeps going. However, it's suggesting that there could be some consolidation in here. It might consolidate a little bit and slowly gravitate. Maybe let the 7 catch up with it. It might come back here. You know, it broke up through 50 a couple days ago and has not retested that level. It might just consolidate a little bit as it reaches it. We're also on the 200-day moving average at this point. A break above the 200-day moving average, which is doing today so far, that would be very positive. Difference between slow stochastics and fast stochastics is just the settings. The settings on a fast stochastics, it's going to give you quicker moves. I mean, a lot more signals, and maybe get you in a little bit faster. But really fast moving indicators don't tend to be all that accurate. They're just too fast. We use a slow, it's going to give you a little slower signals. However, I mean, when I say slow, it's going to give you some decent signals, but they're going to be a little bit more accurate than others. And play with those. I mean, pull up the slow stochastics and the fast stochastics and see how they react to the stock price. All right, Deb, good question. Okay, everybody, thanks for tuning into today's class for Education Week. We'll have another one a little bit later on this afternoon. Watch for that one as well. Have a great day, and we'll see you on chat. Thanks. Bye-bye.